Hi friends, we are going to discuss regarding the external benchmarking of interest rates by banks in our country. Because recently there has been a lot of confusion among students on how individual banks are fixing their interest rates for customers. Long back, banks used to fix their lending rate based on a benchmark rate called as base rate. Later, this base rate was replaced by a new system called MCLR, Marginal Cost of Funds Based Lending Rate. So, right now, this is the benchmark on which banks fix their lending rates. This MCLR is calculated by each bank individually. This MCLR is reviewed on a monthly basis for each loan based on its tenor. It could be 1 year, 2 year, 5 year or 10-year loan. So whatever tenor of loan it could be, the MCLR is reviewed every month by each and every bank. This MCLR is an internal benchmark fixed by each and every bank, which means that each bank fixes the MCLR based on certain internal parameters like cost of operations, the spread or the margin, the profit earned by the bank, the non-performing assets and some other criteria. So this is basically an internal benchmark fixed by each and every bank. So right now the MCLR is the main benchmark rate based on which banks lend to customers. This is the minimum lending rate. Any bank cannot lend below the MCLR. This is what you should understand. But from October 1, 2019, the Reserve Bank of India, RBI, the Central Bank of India, it gave a notification, a circular to all banks mandating that all banks should link their floating interest rates to an external benchmark. What you should understand here is that MCLR, which is already existing, is an internal benchmark. Now banks have to link their floating interest rate, lending rates, to an external benchmark. Floating interest rate means the interest rates will vary from period to period. That's called floating interest rate. The opposite of floating interest rate is fixed interest rate. The interest rate on the loan will be fixed. Now, these floating interest rate loans have to be linked to an external benchmark. External benchmark means benchmark is a standard. So based on some external standard, the floating interest rate have to be fixed as per RBI's new guidelines. Now, what are these new external benchmarks? One is the repo rate. We all know what repo rate means. Repo rate is the rate charged by RBI to banks for lending from RBI for their short-term operation. This is the repo rate. Whenever RBI increases the repo rate, the lending rate of banks also will increase. Whenever repo rate decreases, the lending rate of banks also will decrease. So this is an external benchmark. Apart from repo rate, the other external benchmark is the treasury bill. One is the 3-month treasury bill and the other is the 6-month treasury bill. Treasury bill is nothing but government securities, government bonds issued by the government. So this is also a external benchmark. These treasury bills will carry a coupon rate or interest rate. So this is also a external benchmark. Apart from this, the banks can fix the floating interest rate to some other external benchmark also, that is fixed by an agency called FBIL. So this is what you should understand. All floating interest rates have to be fixed, have to be benchmarked with an external benchmarked rate. So this is the new guideline followed by all banks in India. Now, why this new change? Now, before this external benchmarking, what generally happens is that even though RBI regularly reviews the repo rate, RBI reviews the repo rate every 2 months. Whenever RBI reduces the repo rate, the banks have to pass this benefit to the customers. For example, if RBI reduces the repo rate by 30 BPS, the banks will also need to reduce the interest rate on the loans also. But generally, this does not happen because the banks have been following the MCLR system, which is an internal benchmark fixed by the bank based on its own internal criteria. That's why even though the repo rate gets reduced quite often, the benefit does not pass on to the customers. Generally, the MCLR also gets revised, like I said, every month. But generally, the benefit passed through MCLR is not that great. This is the problem. That's why RBI stepped in to fix or link the floating interest rate to an external benchmark like repo. Now, whenever RBI reduces the repo rate, now the banks does not have any other choice than to pass the benefit directly to the customers. Now, let's say if RBI reduces the repo rate by 40 BPS, the banks will also have to reduce the interest rate on loans by 40 BPS on the loans. So this is what you should understand. So basically this change has been brought on to bring and benefit the consumers. This is mainly meant for retail loans as well as MSME loans. Once again, I am repeating. Right now, banks, they follow two systems. One is the MCLR system, which is the internal benchmark that is already followed by the banks. The other is the external benchmarking system. Like I said, this is mandatory for all floating interest rate. The existing system is linking the interest rate to external benchmark like repo rate, 3-month treasury bill, 6-month treasury bill, or any other instrument laid down by the agency FBIL. If needed, the banks can also link fixed rate interest rate to the external benchmarking also, but it is their own choice. So this is it. I hope this video is helpful to you people. Thank you.